On the 5th of August, 2024, Japan's stock market had its worst single day in 37 years, down 12% before lunch. On the same day, American stocks fell, crypto fell, currencies from Mexico to Turkey fell. One single trade connected all of it, a loan. The biggest, cheapest, strangest loan in the world. This is the yen carry trade, what it is, where it came from, why it refuses to die, and what happens to your money when it finally unwinds. Stay with me. By the end of this video, you'll understand it better than most people on Wall Street pretend to. Imagine your town has two banks. The first bank lends pocket money for free, 0 interest. The second bank, right across the street, pays you 5% just for parking money there. So, what do? You borrow from the free bank, walk across the street, deposit it at the other one, and keep the difference. That's it. That's the whole trick. Now make the free bank Japan, make the street the Pacific Ocean, and make the pocket money trillions of yen, and you have the carry trade. Borrow yen at almost nothing, swap them for dollars, buy anything that pays more. American government bonds, stocks, even crypto. Your profit is the gap between the two rates. And for years there was a bonus. The yen kept falling, which made your yen debt cheaper to pay back. One catch, just one. Your debt is in yen. If the yen ever rises, fast, the free loan becomes a trap. Remember that. It's the whole ending of this story. To understand why Japan gives money away, you have to see what Japan was in 1989. The Tokyo stock market closed that year at its all-time high, 38,915. Japanese stocks were worth roughly a third of every stock on Earth. Of the 10 biggest companies in the world, most were Japanese. The biggest bank in the world was Japanese, and so were the 6 after it. Land in Tokyo's Ginza district reportedly traded at prices that would look like typos today. America wrote bestsellers asking if Japan had already won. That was the top. Then it burst. In 1990 alone, the market halved. By 1992, it had lost 60%. Tokyo property eventually gave up around 90%. And here's the number that explains everything that follows. The Japanese stock market did not see its 1989 peak again until February of 2024, 34 years, an entire working lifetime underwater. So Japan did something no country in modern history had ever done. It made money free and kept it free for a quarter of a century. Stop and actually look at how long that is. 25 years, 300 months, more than 9,000 days. The dot-com bubble burst, Japan's rate still 0. The 2008 financial crisis came and went, and what little Japan had raised went straight back to 0. A pandemic shut down the world, below 0 by then. A baby born the month Japan first cut to 0, finished school, finished university, and started a career before Japanese money stopped being free. Nothing like it had ever been tried, and the whole world learned to build on top of it. In February 1999, Japan cut interest rates to 0, the first major economy ever to do it. In 2001, it invented something called quantitative easing. By 2016, it went below 0. Banks were charged for keeping money. Why couldn't Japan just raise rates like everyone else? An economist named Richard Koo gave the classic answer. After the bubble, every company and family in Japan was busy repaying debt at the same time. When everyone repays at once, nobody borrows at any price. So free money wasn't a stimulus, it was life support, and it stayed plugged in for 25 years. But hold on, if Japan lends money at 0%, where does that money come from? Here is the secret. A central bank does not find money, it creates it. When the Bank of Japan buys a government bond, it types brand new yen into existence. A keystroke, not a printing press. The Bank of England has published a paper explaining that this is how all modern money works. And Japan used that power like no one ever had. Its central bank's assets grew bigger than Japan's entire yearly economy, and it ended up owning half of all Japanese government bonds. From 2013, this even had a name, Abenomics, flood the economy with new yen on purpose. And the bigger idea behind it is now called modern monetary theory. Borrow in your own currency, and you can always create the money to repay. Japan is the world's test laboratory, but there is one catch. Create too many yen, and each yen buys less. That is a big reason the yen kept falling, and the carry trade kept paying. And that leads to a twist that changes everything you thought you knew about government debt. In theory, a country that borrows in its own currency can never be forced into bankruptcy, because it can always create the money to pay. That includes America. Its debt is in dollars and it prints dollars, so the old-fashioned government default may be a thing of the past. But listen carefully, the bill still arrives, just through the back door. Not bankruptcy, but inflation and a falling currency. And debt in someone else's currency can still sink you. Hold that thought, because it explains everything that happens next. Now put the two halves together. Japan lends at zero. The rest of the world pays more. By the late 90s, the smartest money on earth noticed, and the carry trade was born, the shadow of 1989. It blew up for the first time in the autumn of 1998, when panicked traders repaid their yen loans all at once and the yen surged 15% in days. It blew up again in 2008. Each time, it came back. Economists wrote entire books about this. There's a reading list on screen and in the description, and one of them, a 2008 paper from the National Bureau of Economic Research, gave us the best one-line summary you'll ever hear. We'll get to it. Then came the monster years. In 2022, America raised rates to 5.5% to fight inflation. Japan stayed below zero. That gap, 5.5 points, was the widest, easiest, most crowded free lunch in modern finance. How big did the trade get? Honestly, nobody knows, and be suspicious of anyone who gives you one clean number. The clues are enormous. Japanese banks had lent around $1 trillion abroad. Japan's total net claim on the world is over $3 trillion. Some of that is the carry trade. Enough of it that when it moves, everything moves. America runs on borrowed money, and these are its lenders. Every bar on this board is official US Treasury data. For years, the top of the list was a two-horse race: China, then Japan. But watch the board. China has been selling for a decade, sliding from first place to third. By 2025, even the United Kingdom had passed it. Now watch that duel up close. In the year 2000, China held barely $100 billion of American debt. By 2008, it took first place. It peaked in November 2013 at $1.32 trillion. Since then, one-way traffic. Today, Japan is back on top with about $1.25 trillion. But here's the strange part. The biggest lender on this list might not be a country at all. 750 kilometers south of Miami sit the Cayman Islands, population 90,000. On paper, they hold $443 billion of US debt. But the Federal Reserve's own researchers checked who really owns the bonds and found nearly $2 trillion. More than Japan, more than China, that is roughly $20 million of American debt for every single resident. How? No income tax, and 3 out of 4 of the world's offshore hedge funds, sources on screen. Which brings us back to that Tuesday in August 2024. Japan had nudged rates up. America printed one-week jobs report. The yen rose and the machine ran in reverse. When the yen rises, carry traders lose money. Losing traders get margin calls. To pay them, they sell whatever they own: Japanese stocks, American stocks, crypto. Then they buy yen to repay the loans, which pushes the yen higher, which triggers the next margin call. That's why markets that have nothing to do with Japan all fell on the same day. It was the world's margin loan being called. That NBER paper put it perfectly. Exchange rates go up by the stairs and down by the elevator. The carry trade earns pennies every day for years. And it can lose years of pennies in 1 week. And then, weeks later, they rebuilt the trade. Of course they did. The gap was still open, which raises the only question that actually matters. People always ask for the magic number. At what interest rate does the carry trade collapse? Here's the honest answer, and it's the most valuable thing in this video. There is no magic number. It's not a level, it's a speed. A 5-point gap pays you 5% a year, but the yen can move 6% in a week. So the trade dies not when the gap is small, but when the gap starts closing from both ends. Japan hiking while America cuts, because that's when everyone tries to leave through the same door at once. August 2024 proved it. The unwind started with Japan at just 0.25%. It wasn't the level, it was the turn. The rules of thumb and their rules of thumb, not physics. Around 5 points and stable, the trade thrives. Closing from both ends, the exit music starts. Compressed to 2 or 3 points, the trade no longer pays for its risk, and history says that's exactly when crashes happen, because the crowd is biggest just as the reward gets smallest. As I record this, in August 2026, Japan 1%, America 3.5 to 3.75, about 2.6 points, closing, from both ends. That's why, in the summer of 2026, something happened that hadn't happened in 15 years. The yen fell to a 40-year low, and Japan spent roughly $59 billion defending it. Then America joined in. 2 treasuries, 1 message. The unwind of the world's cheapest loan had become everyone's problem. So here's the takeaway. Education, not advice. You now know what professionals watch, the yen itself. 1998, 2008, 2024. Every time the yen rises fast, it means someone, somewhere, is being margin called, and the selling shows up in markets that look totally unrelated. A slowly falling yen is the sound of the machine humming. A fast rising yen is the sound of the elevator cable snapping. The 5 questions. One more time. What is it? Borrowing where money is free and investing where it isn't. When did it start? It's the shadow of 1989. Japan made money free in 1999 and the trade was born. Why did it last? Because the gap stayed open for 25 years. When does it end? No magic number. Watch the speed, watch both ends of the gap. And who gets hurt? Anyone standing on what the borrowed money bought, which, by now, is almost everything. If this finally made the carry trade click, subscribe. Every week I turn one big money story into plain English. Next, the strangest lender on America's list. How a tiny island with 90,000 people ended up holding $2 trillion of US debt. I'm Nova, an AI presenter. Every fact in this video is dated and sourced in the description. This is the Nova Market Brief.